Welcome. This is Quick Capitalization Rate Spreadsheet, video tutorial number 1. My name is Jeffrey Smith. This spreadsheet demonstrates the equations for converting loan parameters, debt coverage ratio, annual interest rate, amortization periods, loan-to-value ratio, into the debt yield, cap rate, and cash-on-cash return, also called the return on equity. You don't need income and expense at this point. You need the 4 parameters specified here in yellow from your lender to calculate the debt yield for the lender, the cap rate for the property valuation, the cash-on-cash return for the net cash flow. This is an example from a hard money commercial mortgage broker who was requesting a loan from a lender under these parameters for a property with $1 million valuation and $80,000 in net operating income. That's an 8% cap rate. Now, if we look at these numbers, a 75% loan to value on $1 million property, the loan request was for $750,000. The borrower would invest 25%, $250,000. But we look here, we already know that this loan will not fit a $1 million property because the cap rate is 11.4353%, not 8% that the mortgage broker was claiming. This was a nonsense loan. Now, this mortgage broker said that the lender said that this property would only support a 62.5% loan-to-value ratio. The problem is that a 62.5% loan-to-value ratio would only support the debt service and no cash flow for the borrower. Let's take a look. Change the debt coverage ratio to 1, which means that all the net operating income goes to the lender. And now we come down here to target leverage calculations, and we plug in 8% for the target cap. We can calculate the loan to value that can support this property at 8% cap rate. This is simply taking the equations, the target leverage cap, dividing it by the product of the debt coverage ratio times the annual debt constant. So we take this derived LTV, Control C, we're going to copy this into loan to value ratio, and now we see that yes, we've calculated an 8% cap rate, but the cash-on-cash return is 0 because the entire net operating income will go to the lender. Now, this 65.59% is very close to 62.5% that the mortgage broker claimed the lender was offering. That's suspiciously close, and it probably means that the lender was willing to lend this percentage of valuation and hold back or roll in about 3 points for origination fee. Now let's take a look at the income and expense. We've set this up so that the income and expense has a gross scheduled income minus about 8% vacancy and about 40% operating expense, yielding net operating income $80,000. The annual debt service is $80,000. Net cash flow is 0. 8% cap rate, $80,000 net operating income. We can reveal the capitalized property values, $1 million. Splitting it along these percentages, the borrower would have to invest $344,000 instead of $250,000 for zero return. What would it take for the borrower to achieve a debt coverage ratio of 1.25 with this interest rate, this amortization period? What would be the loan to value ratio? Well, we come down here, plug in 1.25, and the loan to value ratio would have to be all the way down to 52.47%. Plug it in, and 1.25 debt coverage ratio. There's the 8% cap rate, the $1 million valuation based on $80,000 income, and now the borrower must come up with $475,300. Cash on cash return is all the way down to 3.37%. Leverage to yield all the way down to 0.42. This is a terrible deal. Very negative leverage. Just awful. What would it take to do a 75% loan to value on a $1 million property valuation? Well, we have to look at changing the interest rate. Target cap 8%, derived interest rate, plug that in, and now we have a $1 million valuation, $250,000 equity investment, 75% loan to value, debt coverage ratio 1.25. We'd have to negotiate with the lender to get the interest rate down to 7.0678%. Now this is hard money, so this would not have worked. The lender would not have reduced the interest rate this much. Also, we're still with a negative leverage. The cap rate is 8, cash on cash return is 6.4. Why go behind the 8 ball, take the risk of debt and default and losing your $250,000 when you could find a property elsewhere that's smaller that you can pay all cash for and get 8% return? All around, this is a very bad deal. Now, the mortgage broker had another scenario, 1.25 approximately debt coverage ratio with a 4.875% loan, 25-year amortization, and he wanted to borrow $900,000. The mortgage broker wanted to close a $900,000 refinance with a debt coverage ratio of 1.25, 4.875%, 300 periods, that's 25 years, and he did not mention the loan to value ratio. He wanted a $900,000 loan. Now this is an interesting aspect, is that the loan to value ratio does not matter for the loan amount. It only matters for the capitalized property value, because the loan amount is determined by the debt yield, not the cap rate. Now, most lenders will also include a loan to value ratio according to a certified appraisal, so that they have protective equity. In case of default, they can sell the property and regain their investment. But that is simply for protecting the lender. It is not about determining how much the loan is, because the first three parameters, debt coverage ratio, interest rate, and amortization periods, we blend the interest rate and the amortization periods to calculate the annual debt constant. Multiplying the debt coverage ratio by the annual debt constant creates a debt yield. And when we divide the net operating income By the debt yield, we get the loan amount. So if we want a $900,000 loan with these first three parameters, we can plug in 900,000 and then calculate the debt coverage ratio that will produce a $900,000 loan amount. Control C to copy, plug in, and there's 900,000 at 75% loan to value. Now watch what happens when we change the loan to value ratio. Let's change it to 70%. Loan to value is still 900,000. We changed the loan to value ratio, so what changed? The CPV, capitalized property value, changed. Let's change it to 60%. It's still 900,000. The CPV changed. Now let's change this back to 1.25 and see what would have to change to the interest rate for $900,000 loan with a 1.25 debt coverage ratio. It turns out that it's 5.1369%. So we increase the interest rate, and the loan is now $900,000. And still we can change the loan to value ratio, doesn't matter, still 900,000, because these first three parameters determine the debt yield, and it's the debt yield that determines the loan amount. 4.875%. Now let's change the amortization periods to get a loan amount of 900,000. Come down here to target amortization calculations. We plug in the 900,000 and we compute 285.3584 amortization periods. Control C, copy, come back up, paste value, and now we have $900,000 senior loan amount. You can try changing the loan to value ratio. It doesn't matter. The loan amount is determined by the debt yield. So with this quick capitalization rate spreadsheet, you can plug in the four lender parameters: debt coverage ratio, annual interest rate, amortization periods, and loan to value ratio, and you can determine the debt yield, the cap rate, the cash on cash return. You can also do what if calculations. What would it take to get a target cap of 10% by changing the DCR? A target cash on cash return by changing the DCR? Target leverage to yield by changing the DCR, or loan to value amount by changing the DCR. Do similar calculations for interest rate, amortization, and leverage. You can use this spreadsheet on your smartphone or tablet because it doesn't require any macros or any kind of what-if calculations involving goal seeking. Just plug in the numbers, do the arithmetic, and you get your answer. This has been Quick Capitalization Rate Spreadsheet, video tutorial number 1. My name is Jeffrey Smith, and thank you for your support.